Did you know that you have some lazy money? Stay tuned because we're going to tell you how to get it working for you. Welcome, everyone, to this inaugural edition of the Filbrandt Talks video series. I'm your host, Kristina Gross. The goal of this series is to provide university professionals with timely and concise information affecting their financial planning interest. Filbrandt Talks are 10 to 15-minute videos you can watch on demand, consisting of expert information from our team of specialists who work with hundreds of professors at campuses across the country. Today's topic is year-end tax strategies and why it's important to think about them and act on them before the end of the year actually arrives. With me today is Scott Kornstedt, a certified financial planner with Filbrandt & Company. Scott, one of the favorite sayings of the chairman of the board of our company, Mike Filbrandt, is, "It's not how much you make, but how much you keep." Our discussion today about year-end tax strategies is focused around that mindset, that you stand to keep more of your money by implementing the ideas you're going to talk about. Scott, talk about what lazy money is and how it can be put to work in a positive way in the last few months of the year.
Well, thank you, Kristina. And I think lazy money is a great way to describe this. This is money that you have in bank accounts, savings accounts, essentially now where you're getting a zero interest rate. So one thought here is if you are not contributing the maximum amounts to your retirement plans, or perhaps you're not even contributing to one of the other alternative plans, use some of this money to maximize those plans before the end of the year. You have the last quarter of the year here to do this. And the thought would be you maximize those plans for the rest of the year. Certainly that is going to decrease your take-home pay. But then you have this lazy money out here in your, whether it's, again, a bank account or a savings account, and that can be used for your day-to-day expenses. So clearly you can't just take that money and invest it directly into the retirement plans, but you can increase those contributions, use this lazy money to take care of your day-to-day expenses.
Our next recommendation is to max out your retirement plan contributions for the rest of the year. Why is that, Scott?
Well, I think you want to do that for a number of reasons. It's certainly going to help you tax-wise. It's also going to help your retirement planning as well by getting additional contributions into those plans. A couple of other things to think about is that if your income is at a certain level, you could also be certain that you're lowering your capital gains tax rates. That could be anywhere from 15 to 23.8%. And certainly if you can keep your taxable income below a certain level, you can make certain that you're at that 15% rate for capital gains. As I mentioned, you're going to be able to be saving more. The other thing to think about is that if you're Medicare age, you could be increasing the premium of your Medicare plan if your taxable income is getting too high. So contributing to these additional contributions to these retirement plans could really save you in some of those Medicare premiums. So right now is a great time to look at all of the investments and retirement plans available to you. Are you enrolled in your 403B plan, a supplemental plan? Does your university have a 457 plan, which can accept additional retirement plan contributions? And again, are you contributing that maximum amount? Take these last few months of the year, make certain that you're doing that, and then you can readjust for 2017 and forward.
The stock market as an investment strategy may make some people nervous. For people who fit that description, there's an alternative that we recommend, right, Scott?
Well, it certainly is, and it's definitely a time for nervous investors. We've had a stock market that's had some volatility recently. We've been at all-time highs in the last 3 to 4 months here. We also have interest rates that are at historic lows, and now we have a Fed talking about increasing rates, whether it be September or December, and certainly into 2017. So certainly concerns on both sides of the markets, whether it be equities or fixed income. We also have this election coming up that is going to be bringing an awful lot of uncertainty to the market. So there definitely is something, and what we use and what we recommend as an alternative to some of this is something that almost all campuses have access to through TI-CREF, and that is TI Traditional. This is a guaranteed product. It offers a guaranteed rate of return and also guarantees your principal. So no matter what's happening with equity markets, with fixed income, with interest rates, this will provide a true fixed guaranteed rate of return and could be a very viable alternative for those nervous about the market.
We often recommend a payroll deduction Roth IRA for university professionals who have it available through the workplace. Why is that, Scott?
Well, I think for a lot of university professionals, this is probably their only opportunity to contribute to a Roth. More than likely, the income is too high to contribute to a traditional Roth plan outside of the university. So the nice thing with these plans, if your university offers it, is that there is no income limitations. You can actually contribute much more inside of the plan, up to the $24,000 maximum per year. What you're also trying to do there is create some tax balance in your overall plan and really give yourself some flexibility, whether it be 10, 15, 20 years to retirement, to have a tax-free source of income through that Roth. So there's some very good options there within most university plans of that Roth investment. And we talked about the lazy money. Perhaps this is another area for that. If you kind of think about it, if you're taking that payroll, it's going through the payroll process, you're paying taxes on it, and then you're just accumulating it in either a bank account, or perhaps you're even maybe investing it into a brokerage account. It may be a little more efficient to kind of pass that through and get that into the Roth type of savings, because from a tax perspective, there's really no difference there. You're still paying tax on that money first, and instead of putting it into a savings account where more than likely you're not earning hardly anything on as far as a rate of return, or put it into a capital gains type of account with a brokerage account where you're going to pay tax on those gains, why not pass it through and get it into this Roth account? You can invest it in really any investment and option available in the plan, and then you can also grow that tax deferred and take it out tax free in retirement.
If you're saving for college in a regular account instead of a 529 account, it's time right now to make that change, right, Scott?
I think it is. And, a lot of people are concerned about, if I'm using a 529 plan, it can only be used for college expenses. And that is a viable concern. But the worst case scenario there is that you pay income tax on the gains, and there is a 10% penalty as well. So, certainly that there is that concern, but I think some of these other issues offset that. So let's say you are saving in a savings account. You're probably getting less than 0.5% rate of return, but you're also paying tax on that interest every year. It's not going to be a great amount of interest, but you do pay tax on that. Or if you're saving in a brokerage account and investing those dollars, you're going to pay capital gains on those assets when you do go to sell and use those investments for college expenses. So with the 529, you don't have any of those considerations, and you also have the advantage of perhaps receiving a state tax deduction on those dollars. They then grow tax-free inside the plan, and assuming you take them out for qualified college expenses, there is also no tax on the distribution. So to my knowledge, this is the only type of investment where you get a tax deduction on the way in, it grows tax deferred, then you also get a tax-free withdrawal on the back end, assuming it's for qualified educational expenses.
For people looking to diversify their portfolios by selling stock, there's an important alternative for them to consider.
I think there is, and especially from a tax planning perspective, this seems to make a lot of sense. And oftentimes people forget about this opportunity. But let's say you have a highly appreciated stock, something that you bought 20, 30 years ago. It's gone from $10 a share to $100 a share. If you were to sell that, you pay capital gains, again, anywhere from 15 to 23.8% on that $90 gain per share. Now, if you wanted to rebalance your portfolio and liquidating this stock was part of that plan, you may want to consider instead, if you're in the regular habit of making gifts to charities, you may want to gift that stock rather than your cash, because you can take that stock of a $90 per share appreciation, gift it to the charity. The charity can sell it, pay absolutely no tax, and you still get the same level of deduction as you would if you would have gifted cash. So something that, again, people overlook quite often, but is a very viable alternative, and typically is a pretty easy process working with a charity to do that.
Scott, thank you for those important tips and how our viewers can keep more of their money with some year-end tax strategies. As a reminder, Filbrandt & Company is a diversified financial services organization that serves the comprehensive financial planning and unique portfolio management needs of university faculty. Our firm began many years ago working with clients at Midwestern campuses. We have grown significantly as a result of strong client referral to others in the national network of university professionals. Today, Filbrandt & Company has a presence on 50 major university campuses and serves clients internationally. Goodbye for now, and we'll see you on the next Filbrandt Talk.